Improving Alpha, Innovation in Investing, ESG, and Technology with Michael Oliver Weinberg is being sponsored by Alternatives Watch and powered by Vidrio Financial. For a 360-degree view of investor mandate activity across alternative investments, turn to Alternatives Watch. Vidrio Financial is the first technology-enabled service for allocators looking to harness investment complexity and make better allocation decisions. Learn more at vidrio.com. That is vidrio.com.
Hi, this is Michael Oliver Weinberg. We'd like to welcome everyone to the Improving Alpha, Innovation in Investing, ESG, and Technology podcast series. Today, Chris Ailman, CIO of CalSTRS, will join us. So listeners have a high-level sense of our roadmap for today. We will start with some background, then discuss investing, ESG, and technology. Investors and business leaders should be able to extract a great deal of value from Chris's insight. On that note, welcome, Chris.
Hey, thank you. Pleasure to be here.
Great. Look, let's start with what is CalSTRS. Obviously, you know it intimately, and I know it as well from being in the business for some time. But, you know, some of our listeners may not be quite as familiar, so I think that'd be a great way to begin.
Yeah, no problem. I mean, it's just a bunch of initials, classic government. It's the California State Teachers Retirement System, which means we cover all the public school teachers in the state of California, which is big, including LA, San Francisco. So 1 million members. It's a giant portfolio, $310 billion in assets. And it's pretty old. California Teachers was started in 1913. So it's older than Social Security and just has a really long, rich history. But, you know, we're 100% focused in on the teachers. Our board is comprised of teachers and people in education. So it's a really neat purpose and a really great group to work for.
Got it. And then in terms of getting a bit more granular, the objectives of the fund, maybe if you could briefly highlight those to contextualize the discussion.
No, thanks. I should have mentioned that. You know, the CalSTRS is a defined benefit, which means the teachers, their retirement isn't based on how they invest or how much they put away. It's a set amount of money that comes out of their paycheck, a percentage of pay. And then they get a fixed retirement benefit depending on how long they've worked, what was their salary toward the end of their career. And then it's dependent on us to deliver that. And so first and foremost, our formula benefit is geared on a 7% run rate of return. So think of not individual years, but a pace per mile for a marathon of about 7%, which in this environment looks high. But I can tell you, I've been managing money for 40 years. In the 80s and 90s, it looked pretty low. So I think it's about the right target. And, you know, with our board, our focus is really to make money in a sustainable long-term way. So we're very focused in on sustainability, on climate change in particular, on diversity, equity, and inclusion, quite a lot of issues, as well as trying to beat our benchmarks and earn that 7% rate.
Got it. That's helpful. And we'll definitely get into the ESG momentarily. Or well, now, you know, why don't we just shift the order a bit? Why don't we start there? Yeah. Okay. Let's go crazy. Why don't we start there now? Look, let's start with the E, the environment. I'll leave it fairly open-ended for you, but I guess, you know, thoughts on carbon, zero emissions, goals.
So let me address the whole issue of E, S, and G. Those initials have really gotten in the way. I talked with Larry Fink recently, and he said publicly he's not going to use those initials anymore, which is like, you know, that means he can never spell the word geese. It's just going to be really tough on him. But thanks. I got to have a little humor. But I think that people have lost track. I had somebody in the media ask me if that was a sector, and I said no. It's long-term business risks. It's just a classification for describing things like pollution, worker safety, cybersecurity, stuff that companies already actually track and measure and boards pay attention to. They just don't lump it into those initials. So it's unfortunate there's a lot of controversy in our country and a lot of division over that. But these are just long-term business risks, reputational brand risks to companies, and investors need to know about them and they need to focus in on them. So for us, because we're going to try and make money over a really long time period, that really is what's key to us, is those kinds of long-term risks. So, and when you talk about the E, that's the one I think that really gets a lot of attention, and it should. I really focus in on the energy transition, that over the next 20 years, you're going to see a massive change in the way we live our lives. I think even in the next 7 years, by 2030, how we move things, where we get electricity from, how we produce steel and cement and aluminum, and even in areas like agriculture. We've been burning coal for about 150 years to move things. And now we're going to have to shift and find other ways to produce that electricity, produce that power to move things. And I think that's going to be an enormous investment opportunity. It's also going to involve some risk. And I would say to your listeners, that is going to dominate the investment landscape for the next, like I said, 20 years, but certainly in the next 7 years.
Yeah, I couldn't agree more. I spent some time with Mark Carney, who, former head of the Bank of England, and I think currently largely with Brookfield now. And I mean, the estimates in terms of what the energy transition will require in terms of global capital CapEx are inconceivable over the next decades. To that extent, though, hopefully this isn't too controversial a question. Where do you stand on exclusion or fossil fuels?
No, nothing's too controversial. We live in a glass bubble. I'm used to it. I think exclusions really is an investment decision. It's not a social decision. And I also would argue it actually hasn't brought about any social change. People will point to South Africa. Number one, that was 1987. I think the world's a little different from then. And the divestment then was actually 5 years before we saw apartheid end. And in between that, there was a banking boycott. More importantly, a sports boycott. And South Africa is a little tiny country. It was easy for the world to gang up on it. This energy transition is huge. It is in every facet of our lives. So excluding one industry, excluding a set of companies, is just turning your back on the problem. It's ignoring it instead of trying to engage and create change. I know people is catching momentum. I've talked to Mark Carney about it. He disagrees strongly with it. To me, that's kind of like the initial reaction is I'm going to take my money and go play somewhere else. Good. That doesn't do any difference. It doesn't change anything. What changes things is talking to people, engaging with people, putting money to work in solutions and changes. And then also, most importantly, helping people who are using coal, gas, oil to convert, to change. They need capital to be able to make those changes. If you ignore them, they're just going to keep doing that. What you need to do is get in there and help them come up with solutions. So we're very focused. It's a big part of our portfolio, and we're growing it in climate solutions, climate mitigation. I can't emphasize enough how much climate is going to dominate your landscape, our landscape into the future, in every facet of life and around the globe. Let me put it this way. I don't want to be alarmist, but if we don't change the way we're living our lives now in the next 7 years, we're going to start feeling the planet fry. And Mark Carney's told me I have to be optimistic because I have to say the other option is pretty darn depressing. So let's hope we come up with some real great innovation and change. And you're right. It's going to require a lot of capital. So big institutions like us, I'm in California. I love to use the analogy of waves. This is a mega trend. This is a big wave. And in surfing, you got to start paddling the board ahead of the wave. You got to time it right and then get up, and it's a great ride. So we're a big fund. We're paddling on the board. We think the wave's coming and we're going to ride it and catch it. We don't want to be too early because then the wave crushes you, but you want to be too late and miss it altogether.
I couldn't agree more with almost, if not everything you said. A huge fan of engagement. I'm largely opposed to exclusion. I don't think that solves anything. And I would even go farther and say, instead of exclusion, for example, at the extreme, if a manager or an investor or allocator has the ability to short, at the extreme, if you think there are bad actors, short them. But
exactly. It's an investment decision. And exclusion is just you're eliminating something from your your sphere of opportunity, which is kind of silly. It's you either buy or you sell, and you're right. If you don't really like it and you think it's going to go down drains, you think they're all stranded assets, then short it. Don't just sell it and walk away.
Totally. Anyway, great. What about this? Again, here in California, quite a leader in the sort of perhaps the social space, and obviously there are differing views. Some might agree, some may not. But curious on the fund's position on the social side.
Oh, you mean people disagree in our country? Really? Wow. I got to listen to your podcast. That's informative.
I'm glad I'm being so enlightening today.
There you go. We feel pretty strongly, and I think companies will tell you that workers are their lifeblood, and the key to them being able to produce goods, services, and taking care of your workers is an important thing, and paying attention to them. A happy workforce is a good performing company. So when we talk to CEOs, the top performing CEOs pay attention to this, and their boards track it. They hire consultants, to do an engagement survey to make sure their employees want to be there. There's some jobs where turnover is okay because you need fresh ideas, but most jobs you want some stability and you want to reward longevity. So for us, it's just part of the mix in a capitalist society. We'd like to see the workers and social side get more ownership in companies. And we believe very powerfully in the power of diversity, whether it's gender diversity, ethnic diversity, age diversity, disabilities, background. The more people in the room that think differently, the better the discussion and the richer the decision. I've often said, if instead of Lehman Brothers, it had been Lehman Sisters, or better yet, Lehman family. I don't know about your family, but my family doesn't just all agree and nod their head. There's a real active debate about everything, even what to put on the Thanksgiving table. So I think there would have been a lot more discussion if you'd broken groupthink and brought in a whole variety of people with different backgrounds. I often point out that, there was a cosmetic company in California where the entire board was white male, pale male and stale. I have 3 daughters. I can tell you, I don't know anything about cosmetics. I don't know why they were there and why they didn't have more variety on that board. And sure enough, it hurt them.
Yeah, I have 2 daughters, and I couldn't disagree again more with you on almost anything you said. Everything in our family is a debate, and yes, I would be incapable. I would largely be incapable of running a cosmetic company. However, my daughters would excel at that, including the 10-year-olds. But moving on to the G, which is I think the least controversial aspect of ESG governance, because it's really hard for I think almost anyone to argue there shouldn't be good governance. But is there anything that you sense or think that, and again, maybe this isn't a fair question for you, but that differentiates your view or CalSTRS' view on governance?
No, I love that question. And yes, it's our stability and our consistency. Our message has been the same since the mid-'80s about diversity on corporate boards, about better ratios of executive comp to worker pay, to be, just clear descriptions and understanding of executive comp. And I think, you're right. Most people will agree that good governance is a good thing. It's tough to measure, tough to break that out. So it's not, it's the least controversial of ES&G. And it's been around, like I said, since the mid-'80s. But what's, I think, frustrating and a challenge is that we see governance ebb and flow. We worked really hard back after Michael Eisner to turn around Disney and get better governance on that board. Because at one point, that board was all basically his best friends, handpicked. We got it, but then Disney started to do well, and the CEO reversed all the changes we made. We had to re-engage again. And now this is the 3rd time we've had to engage with Disney to, again, get the board to be more independent and reverse some of their bad trends that they tend to fall back on. So, what frustrates me is here we are 40 years later, still arguing about governance and pushing companies for better governance. American companies are not little kingdoms and fiefdoms. The CEO is not the king in charge. They need to work for an independent board, and that independent board needs to hold them accountable. So we're pushing For diversity on corporate boards, we're trying to help feed that by teaming up with some major universities to educate people and prepare them for those positions on boards, and really trying to get boards away from just hiring ex-CEOs who are their buddies and really hire people who can add value. You wouldn't, just like my example, you wouldn't want to own a cosmetic company without somebody who understands and lives in that world. You wouldn't want to own a electronic company that provides gaming without somebody who's fairly young. You don't want a bunch of older people like me. So I just think companies nowadays, another example, you don't want to own a snack food company that sells into South America unless you have somebody who can speak Spanish and understands the market in South America. So companies are realizing it. I think the best and the brightest companies and the best CEOs are willing to be challenged and have an independent board who asks tough questions. We don't get to see what goes on in the boardroom, but I can tell you that companies where the board has free reign to really challenge the CEO are actually the best performing companies. I'm sure the life's a little tough for that CEO, but that's why they can earn their money. And they know that they're going to be better for it. Iron sharpens iron. So, you need a board that is a bit independent and aligned with the company, but can ask tough questions. So I think what stands out with us is that we have been at this so consistently, many times the same people. Now companies call us and ask us if their executive comp formula is understandable. I can tell you we've had staff that, have an MBA and run through it and still couldn't figure out from the proxy statement how executive comp works. That means the average teacher has no idea. They don't read the proxy, but even if they did, it's got to be in understandable English. How does the CEO get paid? What are the motivations? It's not a trade secret. And we need companies to be more clean in that kind of disclosure. So I think that's what stands us out. Executive comp, board diversity, and what's absolutely true is our consistency. The fact that we've been pounding on this for 30 years. I was able to say to Michael Eisner, and I've said it to other CEOs, as long as they're public school teachers in the state of California, we're going to own their stock and we're not going to go away. So they better listen to us. They better talk to us. We could actually be a help and improve their company if they'll listen to us. But, we're not, like you said, we're not going to just sell and ignore it. We're going to actually stay in their face the whole time.
Very sensible. Shifting gears. So, there are three primary topics of this podcast series. We hit the first one, ESG. The second one, what about innovating to improve alpha from an investment perspective? Is that possible? Is that something you do? If so, how?
No, absolutely. And, I love the name, but, to me, it's also seeking alpha, just trying to find it. It seems so elusive. These markets are so bloody efficient. It is really hard to outperform. I know that, CNBC lives every day on telling us what stocks to buy and what to sell. As I often tease them, they're fast money. Well, I'm slow, patient money. And that's actually how you make a return, not by being fast, but by being patient and investing steadily. So for us, innovation is first capturing the beta of a market. In other words, the base return of, say, the U.S. stock market, making sure we get the entire stock market return. And we do so incredibly efficiently so that we're capturing 99.9% of the return net of all costs. The average person with money in a mutual fund is probably only picking up about 91, maybe 85% of the return on the market because of the embedded costs in what they do. So especially at our size, at 300 billion, costs matter. Then around that, though, we're trying to innovate and we test drive new strategies in a small scale. I always like to say, as advertised on TV, does it really work that way? And will it work for us if we scale it up? And we are very attentive to geopolitical risk and where we're taking risk in the portfolio. So right now in this environment, obviously, fixed income to us is attractive with the short end of the curve. And now today, the long end of the curve at 5%. You can make a decent return out of fixed income. You can make a decent return in private credit. That gives you diversification around your equity portfolio. Real estate, and that's 15% of our fund is still just locked up. You're not seeing much happen in the real estate portfolio or the private equity market. as they're still trying to react to interest rates having gone up 500 basis points. But eventually those will unfreeze, and those have held value for us. So number one for us to improve our alpha is we put our eggs in different baskets. We own the beta of the market incredibly efficiently and cost effectively. And then we just try and add value around that. Because what you find in a pension plan or a retirement account, take an IRA, you don't have to hit the ball out of the ballpark, to use a baseball analogy, each year. You just have to actually add a little bit of value steadily over time, keep your costs down. And then what you find is you're actually outperform 90% of your peers. And the reason is they're going to have turnover, which creates costs. They're going to jump on what they think is the next best stock or idea, and they're going to be bouncing around chasing ideas instead of just owning the entire market and making a nice steady return.
Yeah, look, I think that too is very sensible. I could discuss those subtopics with you for hours, but in the name of keeping this to a reasonable length, we'll discuss private equity, real estate, and private credit another time. I
agree to come back. There you go. Lock that.
Oh, perfect. Excellent. Round two the sequel will come at some point. Great. Thank you. Kind of you. All right. So let's shift gears to the third major topic of this podcast, which is innovation and technology. How do you innovate? How do you use technology at CalSTRS? Thoughts on that?
You know, technology is such an interesting challenge in this day and age. And when you talk about us at CalSTRS, let's keep in mind, we are a government agency. We're a division of the state of California. We're all state employees. And government, is pretty, let's just say, intentional about implementing technology. But the best point of that, obviously, is Zoom, Teams. That stuff we hardly even used that in 2019. And yet in early 2020, boom, we were all able to go 100% remote and work incredibly efficiently. So I think certainly on the software side, and we're really quick to pick up on a lot of this. We use very complex systems internal because we're so big. We're teaming up with many of our biggest money managers who have their own internal systems and have realized they can package that and sell it as a product. And the world's getting more specialized in investment management, so you're seeing very clearly defined tools for each asset class, the way you measure risk and trying to get that. So the more we get digital in the portfolio, the quicker we can gather information, measure risk. That said, it's still a marathon. So even though you know what's coming up right in front of you, whether it's a hill or a busy road or whatever, you've got to keep your eye on the long-term picture. So we're definitely embracing technology. We don't have any, quote, AI in the portfolio that we're using to make judgments, but we are talking to some of our biggest partners who have been doing that for a while and understand how they're utilizing it. And in our case, we're making technology investments. Obviously, the big seven stocks, the Magnificent Seven, are the largest part of our portfolio because they're the biggest stocks in the U.S. stock market right now. And it's interesting in that area because it's really hard for active managers to own all seven. There's such a large outweight compared to the rest of the market. Most of them can't even own the full market weight and they're underperforming. So in our case, we do. We also invest in venture capital, but what you find in venture is it really is chasing unicorns. You'll get one awesome return and you'll have, say, out of 10 investments, 5 might break even, 4 will lose money, but 1 will be an amazing multiple return. But it just is so hit or miss. It seems so hard to identify which of those. And I often point out to people, look, if you knew social media was going to catch on, you would have poured all your money into MySpace, the first mover in that area.
Yep, remember.
If you're going to be think the world's going to be online and looking at through the internet, you would have still owned America online. So technology is tough. It's hard to figure out which is going to be the winner. But what we do is try to make sure we're invested in enough spaces that after the initial run up, then we can get involved. People love Tesla. but I point out we invested in Tesla in 2001. We actually rode it to zero twice and had to put more money in just to maintain our position. And I remember the last time around 2010, I said, are we just throwing good money after bad? And they said, no, they may never build a car, but they're going to make money on technology. And when I tell people that story, they just can't believe that's true, because now they see Tesla and they see the stock price and they think, well, of course it was a easy decision. But it's like, no, you would have gone through almost 10 years of no rate of return. Would you have still hung in there, or would you have cashed out? That's technology investing for you. So it's not easy. But I think embracing technology is what I've said to my staff is we have to be in an environment of continual learning, constantly educating ourselves. Look, I'm old, been in the business 40 years, but I am constantly learning. And a good example would be climate change. I'm spending more time studying biology and chemistry than I ever did. I was a business major. I didn't spend a lot of time in the physical sciences, but now I need to catch up and understand that better to be able to make investments.
Hey, question. Regarding your comments on VC, just curious, isn't it a bit, I would have thought it's just in light of your size, 300 billion, which is obviously one of the world's larger asset owners. How do you invest in VC? You don't find that's challenging in terms of that size, or just curious on those thoughts?
No, it's actually incredibly challenging for our size. And, you would think being in California, in Northern California, would be a favorite of those companies. The problem is California has really strong disclosure laws. So, well-meaning intention, the San Jose Mercury News demanded we in CalPERS disclose our venture capital investments because they thought sunlight would be a good thing. Well, it turns out, no, venture likes to be private. They don't like to be exposed, and they don't want to share their inside information. And when they put us under that law, we got kicked out of a lot of VCs. So what's sad is the two big California funds are actually underweight California venture capital, not overweight, underweight. It is incredibly difficult because of size, because the venture funds are fairly small check sizes. So we try to invest in that space, but it's really a small fraction. We're better off being in the growth equity when things start coming to market. When I started the business, there were about 7,000 public companies in the United States. Today, there are only a little bit less than 3,000. There's still 7,000 companies, but 4,000 of them have now stayed and gone private. That means they still need capital, and that's where we can come in. We can also hold them accountable on governance. But when you're private, you can make long-term decisions. You can hurt a quarter's earnings, and everybody's fine with it because you're making investments for the long term, for the future, and that's a better way for companies to operate. We're providing capital in both marketplaces, and that's where we can grow at scale and have a fairly aggressive and large private equity portfolio. Right now, about 16% of our fund is in private equity.
Got it. Well, and then in terms of shifting gears from venture, PE, the investments, at a high level, what's the biggest challenge to achieving your goals for the fund and CalSTRS goals?
I look back over time, and I have to say, I guess I've always said that it looks like another challenging year, but it always feels like it's different now than it was in the past. Well, it was challenging in the 80s and the 90s, but now I look back and I realize, man, with interest rates coming down, I had the wind at my back. It was a lovely time. Now we're in an environment where interest rates have gone up, but we're also in an environment where the Federal Reserve is willing to drop rates to zero and basically finance recessions. That's a really different investment climate. Geopolitical risk is back up. So this economy doesn't match any of my textbooks. I can go back and look and say, hey, the Fed raises rates 500 basis points, yield curve's inverted, boom, recession in 18 months. And I've been saying that now for well over 18 months. So I'll be right eventually, but that's indistinguishable when you're that early from being wrong. So it's a really unique investment environment where it's hard to figure out And the fact that it still is global, but there's geopolitical risk. So where do you go to make money? How do you make money? It's not following a lot of the traditional education we've gotten. And I think that's what, when I look out into the future, if you overlay, as I said at the start, with the fact that I think we're going to have a massive, massive energy transition. I mean, just huge scale. Literally, I can't say it enough. Every facet of life has to be impacted by this change. Otherwise, we're going to fry this planet quickly. That's just a real challenging investment market. I think inflation, while, you look at the generation, I've got investment officers who've worked for me for, say, 5 to 10 years. In their career, inflation's been zero all the time. They don't even think of it as a problem. I started in the 80s when inflation was real, and it's coming back. And I think it's going to be sticky. It's going to be waffling in here. Hopefully it cools back down towards 3, but it's not going to 2. And that is a real challenge when you've got, that basically means the current is moving against you all the time at 2 to 3% per year. It's harder to make money. And in this interest rate environment, we haven't adjusted to interest rates being up at 5%. So I've been very clear. It's not higher for longer. It's just higher forever. I think we're going to have rates in the 3 to 5% range for easily the next decade. If you take a look at the amount of interest the U.S. government is going to have to pay on the federal deficit, it is staggering. It is going to take, it's 3% off GDP. It is going to dominate the budget. I don't know how our country is going to keep, number one, running at a deficit and paying interest on this debt is really going to start crippling us.
I couldn't agree more. I've been a member of Pete Peterson's fiscal foundation for some years, and they were very early in I would argue flagging this and saying, "Hey, this is unsustainable." And that was way pre-pandemic, and since the pandemic, as you're intimately aware and familiar with, we've just escalated it dramatically with all that fiscal policy and. So I couldn't agree more.
We've been socializing recessions, which is nice for the average citizen, but our kids, our grandkids are going to pay for it. And you look at the size of the Federal Reserve balance sheet, and it is just truly staggering. And anytime a country does that, ultimately it leads to more inflation. It's just simply you produce more money, print more money. That is inflationary. So I think it's just going to be a tough future.
But speaking of balance sheet size, I'm curious if CalSTRS has any view on China.
We do. We spent well over a couple of years ago, I went to the board and I said, look, we need to really start to understand China. It's growing, at 8%. MSCI moved it from a single digit percentage of the emerging market index up to 40% of the emerging market index. And I really thought I could ask a simple question. I asked the board, is China a friend or a foe? And we talked to some amazing China experts, Chinese nationals, people here in the USA. And when you really step back from the rhetoric and look at the history of the United States, the history of China, China is an amazing story with the amount of people they moved from poverty to middle class.
Yep.
But now that brings on immense trouble. And, after studying that for a year, the answer is China a friend and a foe. And we found out the answer is yes. Both.
That's what I was going to say.
At the same time.
Yeah,
they're a competitor and a compatriot. It is so challenging. So we're market weight. We are not overweight. We are not taking big bets in the private markets. We've had lots of discussions with, the SEC and Commerce Department, Labor Department, Treasury Department, because Washington, D.C. is so worried. And they recently asked me are we investing in technologies that could harm the United States? And I said, I'm sorry, you're the United States. You're the one that has to tell me what's going to harm you. I can't predict the future. They didn't have any answers for us. So it's like, you need to inform investors of what to avoid. And now they are, which is helpful. It's like, that's fine. Tell us that, what we can or can't. the U.S. and China are very independent, yet at the same time, it is an enormous geopolitical risk. And I want to emphasize, the global CIOs talk about this a lot. Geopolitical risk is not one of those risks that reverts to the mean. When I mean that, I mean, when you look at PE ratios or inflation, they ebb and flow, but they kind of revert to a midpoint through history. Geopolitical risk is either on or it's off. It's very binary, like a light switch. And so you either, you have to look at Russia. Russia was a tradable market, then 6 months later closed, and any money there is lost. So it is a real challenge for global investors to figure out what to do with China, whether to weight it. I have some peers that just half weight it. I have other peers that avoid it. There are still some peers I know north of us that are overweight. And everyone is looking at that, trying to figure out where they should be and how should they invest. It's an enormous market. And so any company that operates here in the USA, somebody's trying to do something similar in China, but times a billion or 2 billion people, the scale of opportunity is still huge to people. So, but is it investable for us? I don't know. It's an interesting challenge.
Something that's come up in conversation with you a couple of times is, or from my perspective, is the equities. You run them internally or externally?
We run, thanks for asking that. We run over half of the portfolio internally here in West Sacramento, California. We run about 80% of the fixed income portfolio, 85% internal. And we run roughly 75% of the equity portfolio, almost all the USA. A good chunk of the non-US, and even some of the emerging markets is all managed internally. Anything that's indexed or tracking an index, we can run internally very efficiently and effectively. We even in fixed income, we do some active strategies like high yield, a TIPS portfolio. It's just very effective and efficient for us. If we're going to use active management, we'll tend to lean toward external managers. If anything is kind of a quant style, then we can usually try to run some of that in-house as well. I think when I look at our team, terribly talented, but we're a government entity, so that's the wrong business structure to run active money. And so we pick our shots of what we can do efficiently and effectively, and then what we're better off outsourcing to somebody else who can have offices around the world and have boots on the ground to do active management.
And just out of curiosity, where do you stand on hedge funds?
I'm pretty adamant. Hedge funds is not an asset class. It is literally just a contract structure. When you look at hedge funds below the cover, there's over 23 very different strategies, and they can play a role in your portfolio just in different ways. So we used to use 3. Now we're going to go to 2 of those types of strategies that we think are interesting and add value. But you're not going to see we don't have an allocation to a hedge fund category. We don't label it that way. We just look at these as trading strategies and business structures. The only thing that hedge funds have in common is they have high fees and they have usually gates. And they like to use cash as their benchmark, which is like, being a hurdler and just painting the hurdle on the ground and saying you can jump over it. So, I've been very loud and vocal about since they came out. You've got to pull back the cover and look underneath and figure out what is the strategy, what are they trying to do. Multi-strat hedge funds just mean crazy trading all over the place. If you threw 15 strategies into a bucket, it's like 15 scoops of ice cream. It's going to melt and not look very good. So you got to know what you want and what you're buying into.
Question: do you mind saying which 2 strategies you do invest in, or will
we use CTAs, which used to be called commodity trading accounts. Basically, It's trend following managers who are looking at momentum and trend and then shifting around the world. And then we use global macro, and we use those 2 strategies because they tend, not always, but they tend to be able to short the market and provide some diversification. They're less correlated to stocks. And that's why we use them, is they're tools for us to diversify our exposure to the stock market, which is a big chunk of our portfolio. So we want to, again, put our eggs in more than one basket.
What's a red flag when you're looking at a manager that just one example that you wouldn't invest?
We do a lot of manager due diligence. It sounds hard to measure, and it is hard to measure. The number one red flag is actually culture change. I've studied money managers for 40 years, and you can have a different culture. You can have a star system, you can have a team system, but it's really getting down and understanding what's the culture. I find that if it stays consistent, it can produce alpha. In other words, when you have a consistent leadership structure, you perform better as an employee, and all the employees together oftentimes can actually exceed their talent. But when that culture changes, the alpha disappears. The immediate red flags are things like leadership turnover, portfolio manager turnover, simple things like trade violations and sloppy trading. High fees is a big red flag to us. I'll pay for fees if I get a net return, but that already means I'm running with a huge drag on me. And that means it's going to be hard to constantly produce net positive returns, because that's, I'm looking for alpha. I'm looking for somebody who can add value net of cost. And what I find in active management, particularly in stocks in the US and around the world, managers could beat the market, but then when you deduct their fee, you're behind the market. And, I've said active management has a role, but I think it has to really take a look at the pricing mechanism. And it eats up its own value. So there are a number of things when we look at external managers that are huge red flags. We're a giant fund. We do business with new startup firms, but that's pretty rare. Because a first-time firm, as somebody said to me recently, you're not excited when you hire a first-time brain surgeon or a first-time eye surgeon or a first-time babysitter. Those things make you nervous. So, but we do develop managers. We also do business with a lot of big established managers, and we watch them really closely. And that's where we pay attention to the culture. It's hard in this environment because you can't travel as much. Can't spend as much time, and people aren't in the office as much, but it is, I think, a critical element of monitoring a manager is understanding the culture and watching that alpha, because too often you hire a manager because they produced alpha, kind of like chasing, a winner. You suddenly are betting just because somebody's been winning. Well, they're probably due to start losing. And I think too often, when I look at our industry being the institutional investor industry, I would say too often we hire managers at the top and we fire them at the bottom, when actually we want to do just the opposite.
Hey, that's a good segue into what's a mistake you've made investing over your impressive career, and what's a lesson from it?
Wow, my biggest mistake. Hey, it's great to interview with you. So, but I got to run. That's always a hard one. But I remember them like they were yesterday. I think I remember 2008, letting the emotion of that environment hit me. It was hard to buck that trend. I look at some of my peers that rebalanced in March of 2009, which was exactly the bottom. We didn't rebalance until I think about May. So we still caught near the bottom, but we weren't as quick. I remember the very beginning of my career that a manager really pushed one particular stock, and it was going to go public. And boy, did they put pressure on us, and it flopped. And I realized, I need to do my own due diligence. I can't believe what other people tell me. I need to really study something myself. And again, you've got to look beneath the cover. Don't believe the sales pitch. Don't believe the story. You really have to do hard and detailed due diligence. So the simple phrase, and we've all heard it from Warren Buffett, of invest without emotion. If everybody else is greedy, then be fearful. If everybody else is fearful, then be greedy. it's just so hard to do that. I have joked many times. It's just simply buy low, sell high. You can even do it in the reverse order. You can sell high and buy low. It's just really hard to do it.
What's your favorite book or a book that you've read that you like recently? Either.
I'll be adamant. I read the Bible. I read the Bible all the time. I think there's great wisdom and advice in there. And to me, that gives me great comfort. I read a lot of leadership books. Lincoln on Leadership has always been one of my favorites. I just think that, leadership to me has been a big part. Now they offer it as a class in universities. They didn't when I went to school. But I've had some great leaders and I've had some really lousy ones. So I've really learned a lot. It's one of those things, it is like the Bible where I have to read it again. It's like, boy, I knew that, but I need to hear it again because you get out of practice and you forget stuff. And so you need to be constantly reminded.
What advice do you have for other allocators and investors, if any?
I think I see too often that a lot of my peers start to think it's their portfolio, and I would say, recognize your job, your duty. You work for a board or for somebody. Give me your best advice, but it's their money, and you listen to what they want to do and achieve it. I think being consistent, sticking, and not chasing the latest fad. Wall Street is constantly coming up with new ideas, and oh, by the way, they're always the most expensive ideas. So not being swayed by what's new and exciting, because oftentimes it burns out like a flare. So it is simply asset allocation, even though that's often boring to people. That's the number one key is understanding your asset allocation, watching that closely. Rebalancing is not exciting, but that is buying low and selling high, and paying attention to your discipline. So I enjoy talking to my peers a great deal. And it is always interesting, sadly, one, how much they turn over in the USA. But on the other hand, the few that stick around for the long term, how much we really take a long-term perspective. We don't care about one quarter or even a year, because many of us are managing long-term liability portfolios, really focused in on the long term.
I couldn't agree more with you on the on work, working for the board, but it's the client's money or whomever the beneficiaries are. When I was at APG running the alternative portfolio for multiple years, look, I had my team and I, frankly the entire investment team in some instances had entirely divergent views from what the board and they wanted. But as you said, at the end of the day, it was their capital, and we had a fiduciary duty to them, and we had to do what they wanted, and even if there were divergent views. But I agree with you. Last question, as we're running out of time, and it's been super interesting. What didn't we discuss that we should have, or that I haven't asked you, or you're discussing with other allocators or investors, if anything?
Well, the thing that we're talking about, and it gets really into the details, is in this environment, how do you bring people investments, and it's the work environment. So I guess, remote versus in person. Investments is a mentoring business. And while we can work pretty efficiently remote, and especially if the team knows each other and has history together, when we first went remote in 2000, it was seamless. We had our best year producing alpha. Talk about seeking alpha and trying to improve it. That was amazing. But as we added more staff, I noticed a bit of a lack of connection. And you really don't, 70% of communication is nonverbal. You really get a lot by seeing somebody in 3 dimensions rather than 2 dimensions. So figuring out, I think, going forward, how to manage this business with being in person in the office versus remote. It certainly is a very nice work environment to not have to commute, to be able to work from home. But I'm noticing New York firms are back 5 days, sometimes at least 4 days a week. Out here on the West Coast, people are usually 2 to 3 days a week. What's the right balance? We own a ton of office buildings. So what happens to those? What do you need in the office environment going forward to help people work efficiently? When I look back at my career over 40 years, the idea of working at a desk was just a given, was not even, a discussion. You had to commute and you sat in the desk for 8 hours or 9 hours and went home. Now we can sit on our couch and work and sit outside and work. And it is just such a massive transition. It's great. But how do we make the most of it and make it effective? I find my team is really good, 100% remote or 100% in. Hybrid is the worst of both worlds, not the best. So I think going forward, it is really going to be an interesting topic. It's not as exciting as the markets, but it's how we get things done and how do we work effectively.
Interesting. I could go on with you on that one too for some time, but I won't in the name of time as we're running out of time. But look, Chris, we'd like to thank you for that super interesting discussion and sharing your most valuable asset with us, your time. We hope listeners have a better appreciation for one of our more thoughtful asset owners is thinking about and how we'll all benefit from it. This is your host, Michael Oliver Weinberg, hoping you join us again for our next episode, where we speak with another thought leader who will provide insight into improving alpha via innovation. And thanks again, Chris.
Thank you for listening to Improving Alpha Innovation in Investing ESG and Technology, sponsored by Alternatives Watch and powered by Vidrio Financial. With Vidrio Financial Asset Managers, endowments and foundations, pensions, family offices, insurance plans, OCIOs, and sovereign wealth funds can cut through the complexity of asset allocation to reduce costs, mitigate portfolio risk, optimize compliance controls, and improve performance analytics. Interested to learn more? Contact us today at vidrio.com. That's VIDRIO.com. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vidrio Financial or our host, Michael Oliver Weinberg. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.